Welcome, ladies and gentlemen, to another edition of Accounting 101 Made Simple by J. Ham. Today's topics discuss lesson number 5. We will be covering current liabilities on the balance sheet, part 2, short-term debt and interest payable. So we'll start off with short-term debt. Short-term debt is a company's financial obligations that are expected to be paid off within 12 months. It is classified as a current liability on the company's balance sheet. It also represents the current portion of any long-term debt that is due within 12 months. The two main types of short-term debt include the following: notes payable and mortgage payable. Notes payable and related interest payable. Notes payable is a liability account where a borrower records a written promise, which is called a promissory note. The maker of the note, the company borrowing the money, creates a liability to the other company, the company lending out the money, promising to repay that company with interest. An example of notes payable is simply a loan issued or given to a company by the bank. So for example, say your company issues a note payable to Chase Bank for a $100,000 loan due in 6 months at 8% simple interest. Your company would receive $100,000 and increase its cash account and notes payable account for $100,000 to record the transaction. Then after 6 months, your company would not only have to pay back the $100,000, which we consider the principal, but also they would have to pay back the $4,000 in interest as well. And that's calculated as the principal, the unpaid principal, times the annual interest rate times the amount of time that has elapsed. So the amount of time that you were holding on to the money. In this case, you held on to the money, or the company held on to the money for 6 months. So we would do 6 over 12. So $100,000 times 8% or 0.08 times 6 divided by 12 is equivalent to $4,000. So that means after 6 months, your company would pay $104,000, which is the $100,000 principal plus the $4,000 interest to Chase Bank in order to pay off the entire note payable. That's pretty much the gist of notes payable. Mortgage payable. Mortgage payable is the liability of a property owner to pay a loan, usually from a bank or other financial institution that is secured by property. Any portion of the debt that is payable within 12 months is classified as a current liability on the company's balance sheet. The total amount due represents the remaining unpaid principal on the loan along with the interest. The interest that is payable to the lender gets recorded in a separate account called interest payable, which will be discussed later in the video lesson. For an example, say if your company takes out a $10 million 10-year mortgage from Chase Bank on January 1st to purchase a large building. Your company would record that $10 million in the mortgage payable accounts. And I put accounts as plural because you have to break out the total mortgage payable between current and non-current. So $9 million would represent the long-term mortgage payable account, and $1 million would represent the current mortgage payable account. So on February 1st, your company would reduce the current mortgage payable account by an amount of $54,660.93. Please refer to the mortgage amortization schedule for calculation of the principal and interest. That's when the company makes the February 1st mortgage payment of $121,327.60. Note, at the end of every month, the company uses something that is called an amortization schedule to determine the exact principal and interest amounts that make up the monthly mortgage payment to be recorded. This will be covered in a later video lesson when we go over debits and credits more in detail, when we get into the calculations. So I took the liberty of creating an amortization schedule for this mortgage payable example. So at the very top of the amortization schedule, you have all your inputs. You have your loan date, your principal amount, your interest rate, your actual payment, which is the actual mortgage, monthly mortgage payment, and the number of mortgage payments. So in the example that we used, the loan date was January 1st, 2021 rather, and we borrowed $10 million. It was a $10 million mortgage. So we put the principal as $10 million, and then we plug in the interest, the simple interest rate of 8%, and then we come up with our mortgage payments. I did a manual calculation to determine the mortgage payment, but we'll get into that in a more advanced video lesson when we're calculating expenditures and things of that nature. So if you look at payment number 1, it covers January. It covers January 1st through January 31st. And if you notice, the principal amount, as we stated earlier, is $54,660.93. And the interest is $66,666.67. Notice that both the principal and the interest is always going to make up the same mortgage payment. So if you look at all of the mortgage payments on this amortization schedule under mortgage payment column, you'll notice that the amount is exactly the same to the penny. The mortgage payment never changes. The only thing that changes are the two components of the mortgage payment, which are the principal and the interest. And the reason why they change is because you're constantly paying down your principal balance, and you're constantly recalculating what the new principal and what the new interest is going to be based on the newly paid down principal balance. But again, we'll get into this in greater detail as we go over the income statement and its related elements. Interest payable. Interest payable is a current liability stemming from debt that a company has taken. It represents the cost of borrowing money. It is a liability for the company who's borrowing the money, and its sales or revenue for the lender, the bank or the financial institution that's actually lending out the money. Interest payable is always classified as a current liability on a company's balance sheet. It is never classified as long-term or non-current. And the reasoning behind this is that the interest must first be incurred in order for the company to record the liability. As previously discussed, interest that is payable to the lender, usually a bank or other financial institution, gets recorded in a separate account called interest payable. Now, sticking with our same example, say if your company takes out an 8% $10 million 10-year mortgage from Chase Bank on January 1st to purchase a building. On January 31st, the company has incurred 1 month of interest, which runs from January 1st to January 31st. Your company would record interest payable in the amount of $66,666.67. And that is the $10 million remaining principal multiplied by the 8% interest rate, or expressed as 0.08, and multiplied again by 1/12 of a year. 1/12 of a year is the month of January, which represents 1 month. And that would be paid on January 1st as part of the monthly mortgage payment. Problem time. Question number 1. ABC Company issues a 9-month promissory note to HSBC for $300,000. How would the company classify this on its balance sheet? A, non-current asset, B, long-term liability, C, current liability, or D, current asset. Now, remember that side note that we always have when we're tackling multiple choice questions. And that's when solving multiple choice questions, always eliminate the obvious wrong answer to increase your odds of answering the question correctly. So which of these choices can we obviously eliminate? So since we're talking about liabilities here, because we're borrowing the $300,000 from TD Bank, we could eliminate all of the asset questions. So A, non-current asset. No, we're not talking about a non-current asset. We can X that out and move on to the next one. Let's look at D, current asset. Again, we're not talking about assets, we're talking about liabilities. So answer D, we could eliminate that as the potential correct answer. So we're left with B and C. So B is long-term liability. Let's look at that. What's wrong with long-term liability and why it's not the answer to the question? The reason why it's not the answer to the question is because ABC Company is issuing a 9-month promissory note for $300,000 on 9 months. So 9 months they intend on paying this liability, this promissory note back to TD Bank. So it wouldn't be a long-term liability. So we can move on to C, current liability. It looks like a current liability to me because we're issuing the note to TD Bank for $300,000 and we have the anticipation of satisfying that liability within a time period that's less than 12 months. And as we know, any liability that the company or the person intends on satisfying within the 12-month period automatically gets the current classification. Contrary to that, if it was a 16-month note or a 24-month note, 2-year promissory note, then it would be a different story because we anticipate on paying off the liability in a time period that's greater than 12 months, and that will receive the long-term liability or non-current liability classification. So the answer to question 1 would be C, current liability. Question number 2. On January 1st, ABC Company issues a 6-month 9% interest note to HSBC for $400,000. On January 31st, how much interest would be payable to HSBC? A, $10,000, B, $7,000, C, $5,000, or D, $3,000. Now, because we can't apply the process of elimination to these multiple choice questions because the answers are so close to each other, they're closely related, we're going to have to solve this question via a calculation. So we have to calculate the interest. And how do we calculate the interest? We always take the principal, we multiply it by the annual interest rate, and then we multiply it by the time that we had that money. So if we plug in the numbers from the question, we have $400,000 of principal, we have 9% interest rate, or expressed as 0.09, and multiplied by 1/12 of a year or 1 month. So if we take the 400,000 multiplied by the 9% and multiply it by the 1/12, that will be equivalent to $3,000. So the answer to question 2 is D. $3,000 would be the interest that we would owe to the bank. In the next video lesson, lesson number 6, we will be covering the following topic: current liabilities on the balance sheet part 3, salaries payable, overdraft payable, and unearned revenue or sales. Ladies and gentlemen, if you like my work, please hit the like button on this video. Please subscribe to this channel. Please share this channel on all of your social media, and please sign up to become a Patreon member to enjoy exclusive benefits such as one-on-one tutoring, one-on-one consultation, and more in-depth accounting examinations to optimize your learning experience. May God bless you, and see you in the next video.